Hello everyone, and welcome back to the Must Profit Alpha FX Institutional Research Portal. Today is March 31st, 2026, and we are closing the monthly candle with some of the most complex market structures we've seen this quarter. In this 16-minute deep dive, we are going beyond retail patterns. We are mapping liquidity, identifying institutional inducement zones, and applying our proprietary Alpha Hybrid Intelligence (AHI) logic to four major assets: gold, WTI crude oil, silver, and the NASDAQ 100. Our goal today is simple: to identify where the smart money is hiding and how to avoid the common retail traps in these high volatility zones. Let's head straight to the charts. As we transition from the first quarter into the second, institutional rebalancing is the primary driver of volatility. Large hedge funds and commercial banks are shifting their portfolios, which creates the smart money footprints we see on our charts. Retail traders often look at simple support and resistance, but as institutional researchers, we focus on the why behind the price movement. We look for where liquidity is resting, specifically, where the stop losses of the retail crowd are located, because that is where the big players find the volume they need to execute their massive orders. This month-end closing is particularly sensitive, as many funds engage in window dressing, adjusting their positions to reflect a certain performance before the quarter ends. Starting with XAUUSD on the 1-hour time frame. Gold is currently providing a textbook example of a no-trade zone. If you look at the price action between 4,560 and 4,600, you'll see a very tight consolidation. For most retail traders, this looks like a breakout opportunity, but for us, this is purely a liquidity building phase. The higher timeframe structure is still struggling with a massive supply zone located between 4,600 and 4,700. This area is filled with unfilled sell orders and institutional block mitigations. Our AHI logic suggests that the market is currently inducing buyers. By creating equal highs near 4,600, the market is inviting retail buy stops. Once those stops are hit, we expect a massive liquidity sweep. When we talk about liquidity sweeps in gold, we are referring to the intentional move by institutions to trigger orders above or below key structural points to create the necessary counterparty liquidity for their larger positions. On the daily chart, gold has been in a macro uptrend, but momentum is showing signs of exhaustion. The recent failure to sustain above 4,650 is a red flag for the bulls. Retail traders see the 4,600 level as a ceiling that will eventually break, and they are placing buy orders just above it. This is exactly what the smart money wants. They want to trigger those buy stops to gain the liquidity needed to fuel a significant downward reversal. This is the essence of the power of three concept: accumulation, manipulation, and distribution. Right now, we are in the manipulation phase. Our primary bias remains bearish. Why? Because the smart money footprint is leaning toward a distribution model. We are waiting for a clean break below the 4,500 structure. A candle closed below this level, followed by a change of character (CHOCH) on the lower timeframes, will be our confirmation. Our first objective is 4,450, representing immediate liquidity, followed by our second objective at 4,350, which is the major institutional demand. If price sustainedly breaks above 4,720, our bearish thesis is void. We are not perma-bears. We follow the data. We will only flip to a bullish outlook if the market breaks, and most importantly, sustains above 4,600. A quick wick above is just a sweep. We need a solid higher-low formation. If confirmed, we look toward 4,650 and 4,700. But remember, until 4,600 is cleared with volume, we are looking for sell opportunities from the top of the range. Next, let's shift our focus to the energy sector with WTI Oil. Crude oil has been on a phenomenal bullish run, fueled by geopolitical tensions and supply-side constraints discussed in recent OPEC+ meetings. However, our technical analysis shows we have reached a premium price point. As you can see on the 1-hour chart, price recently tapped into a major premium supply zone between 102.5 and 104.0. Our system has already confirmed a sell label at these levels. This isn't just a random drop, it's a reaction to a high-volume institutional block. Large commercial players often use these price points to hedge their production, creating massive sell-side pressure that overrides retail buying momentum. Currently, price is hovering near 100.8. We are closely monitoring the 99.5 support structure. This is the neckline of the current distribution. A clean break here indicates that the institutional buyers have stepped out and the bears have taken control. Once 99.5 breaks, we are targeting 98.5, 95.0, and eventually the primary demand at 90.0. Notice that the buy-side liquidity above 104.0 has already been swept. This usually precedes a deeper correction as the market rebalances the price. When a liquidity sweep occurs at a premium level like 104.0, it leaves behind what we call price inefficiency, or fair value gaps, FVG, that the market often seeks to fill on the way down. These gaps represent areas where price moved so fast that only one side of the market, the buyers, was filled, leaving a vacuum that must eventually be mitigated. The only way we stay bullish on oil is if the 98.0 primary demand holds like a wall. This level represents the last major institutional buy order block before the recent rally. If we see a strong rejection wick from 98.0, accompanied by a spike in volume delta, we might see one last push toward 104.0. However, the probability of a breakdown is significantly higher given the current volume exhaustion we are seeing on our proprietary AHI indicators. In the oil market, price is truth. And currently the truth is that the big money is looking for an exit at these premium valuations. We must also keep an eye on the dollar index, DXY, as a strengthening dollar often puts downward pressure on oil prices, aligning with our bearish structural view. Moving to silver, XAUUSD. Silver is currently in a very interesting position. While gold is consolidating, silver is testing our patience. Currently, price is sitting in a supply region, and as professional traders we never buy in supply. We wait for the discount. Silver often acts as a lead indicator for gold, but recently, we've seen a divergence. This divergence often happens when institutions are reallocating between precious metals, or when industrial demand forecasts begin to shift. We have mapped out 3 specific zones where we expect the smart money to enter. Zone 1, between 69 and 70, is weak demand. It has been tested multiple times, which in SMC terms makes it a liquidity pool. Retail traders think this level is strong because it has held before. But institutions know that there are thousands of stop losses sitting right below 69. We expect this zone to fail or provide only a minor scalp bounce to trap early buyers. Zone 2, ranging from 66 to 67, is our 9/10 conviction zone. This is a fresh institutional base, where a significant displacement move started previously. Displacement is characterized by strong, impulsive candles that leave behind imbalances. We expect a sweep and react model here, where price wicks below 69 to clear the stops and then aggressively taps into 66 before reversing. This is our primary buy area for a high probability swing move. Zone 3, at 61 to 62, is the ultimate major demand. This is the origin of the entire monthly move. It is untouched and holds the highest volume of buy orders. If silver reaches this level, it is a high-confidence positional play with extreme upside potential. The execution plan for silver is all about discipline. Wait for the sweep of 69. Let the retail traders get stopped out and feel the FOMO, or fear of missing out. When price finally hits the 66 to 67 region, look for our AHI buy confirmation on the 15-minute time frame. Our targets are 70-73 and the major supply at 78. Keep your stop loss strictly below 65 to protect against a deeper hunt into Zone 3. Remember, the market doesn't move in a straight line, it moves to wherever the most liquidity can be captured. By waiting for the sweep, you are effectively trading with the institutions rather than against them. Finally, let's analyze the NAS100. This is perhaps the most clean setup for the day. Our overall bias here is 9/10 bearish, despite the recent upward move. The tech sector has been incredibly sensitive to the macro environment, interest rate projections, and corporate earnings reports. We are seeing clear signs of institutional distribution at the highs. Distribution is the process where large players gradually sell their positions to retail buyers without crashing the price immediately. The move from 22,800 up to 23,300 is what we call inducement. The market is building a bull trap by creating a series of small, overlapping higher highs. This is designed to capture buy-side liquidity from retail traders who are buying the breakout of minor resistance levels. The real institutional interest is in the 23,300 to 23,450 supply zone. We are looking to sell in the 23,250 to 23,400 region. The logic here is simple. Price is coming from a discount and moving into a premium. Smart money is looking to hedge their long positions or enter new shorts here to capitalize on the overextended price. We are targeting a move back to 23,000, then a break toward 22,800, and eventually 22,400. A clean sustain above 23,600 changes the narrative entirely. If the market holds 23,600, then the big players have decided to squeeze the shorts and push for 24,000 plus. But until that invalidation is hit, we remain tactical sellers at the highs. There is a massive liquidity void or imbalance below 23,000. When institutions decide to liquidate their positions, the lack of buy orders in that void will cause the market to drop rapidly as it seeks the next available demand at 22,800. This is where professional traders make their largest gains by catching the expansion phase after the inducement phase. The relationship between the NAS100 and bond yields is also critical. If yields begin to rise, the pressure on tech valuations will accelerate our bearish thesis. Always use a stop loss at 23,600 and don't let a winning trade turn into a loser by being stubborn about the bias. Risk management is the only thing we can truly control in this environment. To conclude today's session, the theme for March 31st is patience. Whether it's gold's mid-zone consolidation, oil's premium supply reaction, or silver's hunt for a discount, the market is waiting for the weak hands to act first. Success in these markets isn't about being right, it's about being on the same side as the volume. Retailers trade patterns, institutions trade liquidity. We must remain vigilant during the London and New York overlaps, as that is when the majority of these institutional moves will be executed. As we close the monthly candle, expect end-of-month volatility. This is often where the most aggressive liquidity sweeps occur as funds window dress their portfolios and institutional desks balance their books. Stay focused on the key levels we've discussed today. At Must Profit Alpha FX, we don't predict, we react to institutional footprints using our Alpha Hybrid Intelligence framework. This systematic approach allows us to stay objective in a subjective market. Always manage your risk according to your personal trading plan, as this research is for educational purposes and based on our proprietary logic. For more in-depth logs, real-time alerts, and to join our VIP community of institutional researchers, visit link to mustprofitfx.com. We are here to provide you with the tools and research needed to navigate these complex markets with professional precision. Thank you for joining me in this 16-minute deep dive. Trade safe, stay disciplined, and I will see you in the next update. Happy trading to you all.